Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are Thursday, February the 13th, 2025, recording this in the morning about 7:30. Okay, so a few interesting things going on. Obviously, we had the CPI yesterday, which came in, of course, higher than expected, quite sharply higher than expected at 0.5, rounded up, was about 0.46, the unrounded number. So the point is here, let's see how the market reacted to that. Obviously, the bonds sold off. There was strength in the US dollar and the equity sold off. But what is interesting to me is that the market didn't the market clawed back a lot of its initial moves. So we didn't actually see that much strength in the US dollar across the board. Bonds, yes, they sold off, but they did bring back a little bit of the losses. We saw the gold actually pushed a little bit higher. And we saw also that the equities, in fact, almost went back to their initial price level at P1 before the data came out. So what is that trying to tell us? It's sort of, I would say, a hawkish message, but not the most extreme hawkishness. And why is that? Let's look at a couple of things. First of all, here we have the break even on the 2 years, which, as you can see, essentially has been going up since September. So it's nothing new here, but it has started to accelerate in the last sort of month or two, and it's now at 3.16. So of course that's the price above of the tips of the inflation adjusted bonds over the nominal bonds. So we see here that the market is definitely pricing in or expecting sort of slightly higher inflation. And I think I showed you yesterday on this video, the inflation swaps are definitely starting to trend upwards. But if we actually look at some of the numbers, it's a little more nuanced in the sense that, yes, inflation is definitely sticky. I think it's definitely sticky. And again, just pulled this from a Bloomberg article this morning. It's got a bunch of interesting charts here. So you see here, again, you see the 2 year on the break-evens, which I just showed you on the Bloomberg terminal there, the white one. So that's definitely going up. But if you actually look at the 10-year in blue and the 5-year break-even, which is what the Fed looks up a lot, that's actually relatively flat. So it's like the market saying, hey, we have a short-term inflation issue, but medium-term things are not perhaps that bad. And then if we actually look at a breakdown of the numbers, what's interesting is that the core services actually went down a little bit. They actually went down a little bit, the core services. So you see here in the red here, you can see that actually ticked down a little bit here. Core goods was up a tiny bit, energy was up a little bit, and food in some sectors, for example, eggs was up a little bit. So one of the things to look at is like, okay, it's definitely inflation reignited and going up. But if you actually look at a couple of different measures, so for example, the trimmed mean, which takes out the most extreme, the sort of the outliers, like the very high and the very low levels. What we're basically getting here, and again, we've got the median CPI, we've got the CPI excluding fuel and energy, and the supercore. The point is here, I would say it is sticky. As they say, the headline here, alternative measures are declining. So clearly there's been a decline, but remain too high. Now, it's important to keep in mind that Powell yesterday at his second day of testimony, he said that one data point, 1 month would not determine. And so, but on the other hand, he also said that they're definitely in no rush. So I think what we have to take away from this is that the Fed is a little unhappy. They're not panicking, they're not hiking, but they're certainly not cutting. So I think pretty simply what the market is telling us and what the Fed themselves are telling us is, hey, we need to see 2, 3, 4, 5 months of strong consecutive downward pressure, and then we will cut. So I think realistically, we're looking at a Fed which is on hold at this point for probably minimum 2 meetings, if not 3 or 4 meetings. But there are other factors in the world, such as Trump, tariffs, geopolitics, and the US economy's performance. They're all wild cards. And as I was trying to figure out here on the board yesterday, like there are risks to the downside in inflation. And so we have to be looking at those factors. We need to identify the factors, and then we need to see if they sort of manifest themselves. So those factors could be that tariffs are instituted, that actually causes a global slowdown in trade, and global economies, and possibly even the US economy catches a cold. The US economy starts to fall a little bit. We have unemployment rates going up, people get laid off, and suddenly we have weakness in the employment market and the US economy. Deflation starts to happen. Let's say, for example, the famous Doge group actually, I mean, Musk yesterday was talking about finding no problem, $2 trillion worth of cuts annually to the US budget. So who knows? Maybe if the budget's cut, there'll be less government spending, less fiscal stimulus, programs are being stopped, unemployment rises up. All of that could lead to a slowdown in growth, which ultimately could be a drag on the US economy, which could be deflationary and could cause the Fed to actually start cutting again. So the point is, it's not beyond the realms of possibility that in, I don't know, 3, 4, 5, 6 months, we could see a different scenario. But that's not where we're at the moment. We just need to understand those factors. The other issue is kind of interesting is where are we? Yeah, just the food. Food is not too bad, but the point here is like the January seasonality. Because yesterday's number in the CPI was a January number, and what we're seeing here is that a lot of companies with pricing power, they do tend often to raise their rates annually in January. So we have seen this a kind of a bump in January. You see here going back over the last few years, there's often been sort of upward spikes in the January CPI. So some people are saying, some commentators and analysts are saying, hey, January, there's normally a bit of a spike upwards. So I think at this point, that's the situation with inflation. Now, of course, that brings us back to PPI. So we have PPI today, and the market normally doesn't pay a huge amount of attention on this. But I think today could be kind of interesting because the market wants to see if the CPI heat, so to speak, the hot number yesterday is repeated. Because remember that once we have the CPI and the PPI inputs, then people who can crunch numbers are able to compute the core PCE number, which of course is what the Fed's most interested in. So this is going to be important today. But let's have a look at it. Final revisions month over month 0.3 up from 0.2. If this number comes out at 0.405, that will, in some sense, quote unquote, confirm the hot number from yesterday in CPI. And I think that could start to put a little bit of downward pressure on equities. Sorry, just looking what I was about to talk about here. Trump says today is the big one, reciprocal tariffs. Okay, we'll get on to the moment, but just looking at PPI here, you see we're looking at 0.3, 0.2 for the numbers. So definitely that is going to get the market's attention. Okay. And just to finish off on that, we have a Fed now, which is not priced for a cut until September. That had been in the middle of the year, sort of July-ish, June, July. That's now been pushed out to September. Let's see. Okay, so I was going to talk about Trump and tariffs, but here we are. We already have a headline on the Bloomberg here at 6:50, so about 30, 40 minutes ago. Okay, so there had been some talk about putting on reciprocal tariffs. What's going on with all of that? We know the situation with Canada and Mexico, that Trump gave them a reprieve for 1 month. There had been some positivity yesterday in the Eurozone with the Euro stocks on this idea that there was negotiations going on between the White House administration and Europe about, avoiding the worst of tariffs. But the thing is here, Trump threatened, it looks as though maybe today's going to be an announcement. I think he has one of his ceremonies signing things at 1 p.m. today, executive orders of basically any tariffs which are applied to US imports, the same amount of percentage tariffs will be applied by the US to those countries' imports. And I was just reading through a bit of stuff yesterday. It seems that countries like, for example, Brazil, Turkey, India, Vietnam might be quite affected by those. So a lot of countries have a very small quantity of trade with the US, and they have relatively high tariffs on US imports into their country. So that's not really the issue. The issue is really countries like Vietnam, Brazil, as I say, India, Turkey, which have a reasonable quantity of trade going into the US, being exported to the US. And so the idea is that tariffs would go onto those. It seems if Trump follows through, but you never know, he changes his mind 2 or 3 times a day. So what are the implications there? It seems to me that you'd have to look into some of the details, but that cannot be good in a broader sense for emerging markets. So let's look at the EEM ETF. Secondly, for the specific countries, that would be a negative. Although we know that India's Prime Minister Modi is actually meeting with Trump very, very soon at the White House. I'm not sure. I think it's in the next day or 2 or 3. And there's some talk of him trying to sort of sweet talk Trump to have some exceptions. But the bottom line is that we seem to be having a little more ratcheting up in the tariff situation at the base, at the margin. That could be inflationary. Is that going to be pro-US dollar? And a bit of a negative for other currencies, especially some of the emerging market currencies. currencies. And that's sort of interesting. And that's going to be interesting to see how the bond market takes that, because we had a 10-year bond auction yesterday, which just stopped through by 1 basis point, which is negative, basically indicating that the market wanted an extra basis point of yield in order to absorb the supply. Today at 1 p.m., we get the 30-year bond market, which is normally pretty sensitive. And if we get around about the same time Trump signing tariffs, new tariffs into law, which is inflationary, it's going to be interesting to see how the 30-year bond market absorbs that. And any sort of failure, so to speak, and high yield could be a negative for the bond market. Yields would go up on the long end, which potentially could be a pressure, downward pressure on the equities. Just going to grab some tea here. So it's interesting here what's going on. And let's look at a couple of charts here. Where are we? Let's look at this one. Because the other big news yesterday, of course, is this copper breaking out here, very interesting level. The other big news is that Trump apparently had a 1.5 hour phone call with Putin. It seems to be, my gut feeling is that there's some kind of grand plan, grand alliance, a bit sort of like 19th century Realpolitik, to use the German word of, chess pieces where the great powers with the capital start manipulating the global map. And it looks to me like Ukraine here is going to be that kind of situation. And of course, we can't help but thinking to 1938 with the Munich Agreement between Chamberlain and Hitler, where they kind of, basically Chamberlain gave Hitler a little bit of the Sudetenland in Western Czechoslovakia in exchange for peace and no more sort of incursions. I'm not saying we're getting that, but it looks at this point as though the US and Russia seem to be coming to some sort of grand alliance whereby, certain territorial parts, gains of Russia in Ukraine will be sort of given, quote unquote, to Russia in exchange for, non-aggression in the future. We shall see where that goes. But just from a sort of a market perspective, and keep in mind that we do have we have a modern day contemporary Munich Security Council meeting, I think this weekend. And the idea there is that a lot of big players are there, and there could be really sort of some serious talk about the future situation with Ukraine. But just in terms of the overall reaction to that, very, very interesting, pretty clearly obvious that the CL, the oil came off. You see here at the fib level, it failed. It's now testing lows, a pretty critical level here as we talk, still going down. And this is basically coming off on the idea that sanctions on Russian oil supplies, which had been a headwind, will probably be removed, or at least sort of softened somewhat if there is some kind of deal between US, Ukraine, and Russia. Basically, more Russian barrels coming onto the oil market. So that's clearly a negative for oil. Unfortunately, I was long here, so just seeing if this breaks down. Might have to exit that trade. But if you look on the April contract, which is about to be the one, we're getting to that level there. Sorry, I just want to have a little quick check here because there had been a little bounce this morning on that. No, it looks like it's coming back down again. So oil under pressure, and that makes sense. The time spreads also under pressure. We also saw yesterday, I haven't checked, but the European gas contracts. Yeah, you see here, European gas contracts coming down on that one, nat gas contracts coming down on the idea that there'd be sort of nat gas from Russia will be flowing more freely to Western Europe. So basically in the energy complex, the idea here is a less expensive energy coming out in at least sort of in Europe. Again, that's going to be a positive for the bond market because that's going to be less deflationary. So again, you see it's getting complex. Interesting, if we get lower energy prices, which is the goal of Besant and Trump, the bond market's going to like that. So we can see here a little bit of green, but especially if you look over in Europe, you see that the Bund, the Bunds actually had a nice little rally there, just in the idea of maybe sort of less inflationary pressures from lower energy prices. So quite interesting. The other thing yesterday, we did get on the back of this sort of news or announcement that Trump and Putin had started to talk, a bit of a risk-on tone, especially in Europe, and that makes sense. So if we see here, we see that the euro, let's go USD euro, up pretty substantially, starting just to face a few headwinds. And again, this is going to be very, very interesting because yes, this is a positive for growth. And who knows, are we going to get some kind of post-World War II Marshall Plan? If you remember, in the late 40s, massive reconstruction building project funded by the US in Western Europe after the Second World War, the Marshall Plan. Are we going to get sort of another kind of Marshall Plan for Ukraine? So who's going to benefit from this? You'd have to say that overall, it's a risk on in Europe. So we see the euro up. We also see For example, the euro up against the Swiss franc, giving back a little bit, but yesterday bouncing on that. So interesting at the triple top there, euro Swiss franc. It did get to that triple top, but now coming back a little bit. And also for euro stocks, we also see the euro stocks, if I can find them, doing pretty well here. So we look at the Euro Stoxx 50. They had been doing very, very well, but basically really pushing up to highs. We see the German index, the DAX pushing up. And what's also interesting is currencies like, for example, the Polish zloty. So we know that Poland and Hungary and Czechoslovakia, they were adversely affected with the fallout from the Ukraine invasion. So we also saw this morning GDP for Poland, which came in quite strong. So something like the Polish zloty, PLN, which has been doing quite well, to be absolutely honest, but let's have a look. Euro PLN. So in some, I mean, again, as you can see, the euro has been plummeting against it. But I just wonder if there's actually a bit more sort of downside for the euro against the zloty. I mean, it's hard to be selling it at this point. But the zloty has been doing pretty well based on outperforming Europe. I just wonder if there's, are we at a key level there? Oh, now see, this is getting to a very interesting level. We'll put that on my little chart here. Sorry, guys, just sort of update the charts here. So we're getting to quite an interesting point here. Now, obviously, the zloty has rallied, as you can see here, against the euro, but just on a weekly, is there more downside? And as you can see, kind of interesting. This is a very key level here, but maybe, who knows? Maybe we'll get some kind of seller's remorse, and then we could continue to push down to 3.96 on the euro zloty, or even down to 3.84. My point being is that Europe, this should be a general risk-on environment for Europe, but within Europe, the winners are going to be sort of those more exposed economies, like, for example, Poland, which should get a lot of sort of extra sort of construction work and whatnot out of this. And the losers could be something like the Swiss franc, let's say euro Swiss franc, which no longer serves as a safe haven. We also know that the Swiss franc, the Swiss National Bank rather, wants a weaker once a week as Swiss franc, just because inflation is really becoming almost quite deflationary. And the Swiss National Bank is getting a lot of pressure from Swiss exporters who want a less strong or a weaker Swiss franc. So definitely, well, I don't know, definitely here, you know, we're looking at the Swiss franc versus the euro and the euro versus the Polish zloty. But again, you'd probably want a slightly more attractive entry point for these. So on the other hand, what is interesting just looking at the currencies, of course, on the other hand, we have the US and the Fed, which is in no shape or form going to be cutting anytime soon, as we just discussed. And you have an ECB, which is still a little concerned about the slowdown in growth. So we have an ECB, which all things considered will be more dovish and will be cutting more than the Fed. And so it's going to be interesting here just to say, well, okay, a little bit of strength in the euro, but on the other hand, is there any real reason for the US dollar to go down? And that's why I do think it's probably going to be better, some slightly more nuanced cross pairs if you're trying to do anything with the Ukraine situation. Because again, just to go back to the euro USD, you can see here on the daily chart that we had this big trade range here in the sort of the pink box. And to be honest, you know, I think it's going to be very difficult for it to breach that at this point. We'd have to see a material outperformance of the European economy compared to the US economy. And I just don't see that at the moment, especially with the monetary policy. And so interesting here, we're seeing the euro go up. I think anywhere, again, you know, up at 105 or so, that probably is going to be a short again, but we want to sort of see those levels. Other couple of quick things to be looking at here, guys. The stocks, again, had a relatively good sort of comeback yesterday. As you can see, still inside the big trading range after that CPI. If we get a hot CPI today, could that put a bit more pressure on the stocks? But I think we'd have to start breaking some technical levels here to really see that fall down. Because as I say, at the end of the day, if the growth, if the inflation is because of a strong economy, that in some way is like a healthy growth, almost like a healthy inflation, and it's not a crazy out of control inflation as we looked at. If you look at some of the nuances of the inflation numbers, some things are going up, but some things are actually stabilizing and going down, and so that's maybe why the stock market can keep on going here. I think really what we would have to see for the stocks to come down, we would have to see. I think breaking some of these trend lines and some of the technicals, fib levels and all that kind of stuff, we would have to see a material rise in the 30-year bond. and maybe even some pricing of the Fed hiking, not just on hold, but hiking. But at the moment, I think the bond market is waiting for more clarity on tariffs and it's just trading in a range. Let's see what happens today. If Trump does, in fact, go ahead and put reciprocal tariffs on, the devil will be in the details. But if the market perceives that to be highly inflationary and a drag on future global trade growth, who knows, maybe the equities could start to sort of top out here. We shall see. We talked a little bit. I just very quickly, guys, want to just look at some of the metals here. Gold, to be honest, you can't keep this baby down. It's like a beach ball. It just you push it down and it bounces back up. I mean, look at gold here on the futures. Well, that's the weekly, but let's say on the daily, well, the weekly very, very strong. You see, you had a little bit of a sell-off there on the CPI, immediately bought on dip. Even despite, for example, potentially peace breaking out in the Ukraine at some point. Although, just on the Ukraine, let's be very clear that we're in the very first innings of a 9 innings baseball match here. There's a lot of negotiation, and there's a lot which could go wrong. So it's not as though that's all out of the wood. And I'm curious to see if some of these sort of peace initiative market movements have faded. But gold here looks strong again, looks as though it wants to maybe retest the high. If that's the case, silver, as I think maybe I spoke about yesterday, had this 61, this big fib retrace here, kind of like a triple, quadruple top, rejected. I've got a little sort of forward projection here. If gold continues to push here, and the global economy seems to be okay, you've got to say that maybe gold could have a push out here. Sorry, silver could have a push higher. And then also copper here, very, very interesting. Again, big fib retracement level, sort of this orange one, if you go back here. It's broken out of this downtrend. Was rejected at this kind of triple top here, came back down just for a day. You see this bit of a red candle here just for a day. It now looks like it's pushing higher. This could push higher, global reconstruction in Gaza, in Ukraine, China, maybe, trying to stimulate a little bit, the US economy doing okay. Is this sort of, are we getting into a little bit of a growth story here? And a copper might benefit from that. So that's definitely an interesting one as well. And again, just on oil, the final thing I just want to say on oil is that yes, we have the whole Russia, Ukraine détente kind of situation, but just keep in the back of our mind that we had, for example, the IEA yesterday, the International Energy Agency, basically saying that global inventories are actually getting to quite a low level historically. They do believe there's going to be far less surplus, so less oversupply in the market in going into the second and third quarters of 2025, and demand from especially from Asia and India is strong and picking up. So it's interesting, oil, just because it's been whacked, but the fundamental story is not bad. It's not super fabulous, but it's not bad. But oil does what it wants to do. So if it wants to puke down lower, it can. But I guess I mean, maybe now the floor is going to be at $67. I suppose that's what's going to be happening. Okay, let's leave it there because time's going on. Have a great day, and we'll be talking tomorrow again, no doubt. Thank you.